Welcome to the Tax and Subjects podcast brought to you by Drake Software. I'm Ryan Norton, and today we're going to be talking about the Tax Cuts and Jobs Act and how it affects individual filers. And to join me for this discussion are two people from Drake Software. We have Robin Miles, the federal tax manager, and we have Bob Nolan, the lead tax analyst. Welcome to the show, you two.
Thank you. It's good to be here.
Well, it's great to have you both, and again, welcome to the show, and we have quite a bit to cover. So we may just go ahead and jump into it. I know usually we have sort of a little intro where we talk about other things, but we're just going to jump into this one because Bob and Robin have a lot of good information for us. And we'll start with Bob. Can you explain the changes that would affect like a normal family? If someone were just to ask their tax professional, they're just the average Joe, hello, Mr. Tax Professional, what are the things that I need to know for my average family? I've got 2 dogs, 2 kids, and I'm married. What are the things that I need to know about the Tax Cuts and Jobs Act that affect me?
Well, some of the broadest changes that'll affect the most people include the fact that the exemption, the 4,000 was scheduled to be 4,150 in 2018 exemption, no longer applies. The standard deduction has been almost doubled, which is going to reduce the number of people that need to itemize in order to get the best deduction. Right. And of course, there's been big changes to the child tax credit. It's gone from $1,000 per child to $2,000, and as much as $1,400 of that can be refundable. And on top of that, you have the new $500 credit that's available for other dependents who they don't qualify as children for the child tax credit. They're over 17, what have you. Another big change to the child tax credit is it'll only be available for dependents that have valid Social Security numbers. Previously, if you had an ITIN, the $1,000 credit was available to you. It will not be in 2018 and forward.
So, Bob, we talked about the standard deduction. By increasing the standard deduction but then taking away personal exemptions, is Congress taking away from families as much as they're giving them? How does that situation play out?
Not as much as you might have thought. When I first saw that, I thought, well, people with large families are kind of getting it in the neck. But then when you look at the new $500 credit that you're getting for each dependent that doesn't qualify for child tax credit, I kind of did the math. And your $4,150 exemption that you would have got for the child would have saved $498 in tax for a family in about the $77,000 a year income bracket. Right. So effectively, they're not taking away anything from moderate income families, and if you're in a lower tax bracket, you're actually coming out a little better.
That's probably good news for a lot of people out there. So, yeah. Robin.
Yes, sir.
Since moving expenses are no longer deductible, what do you have to say about the Form 3903? Is that going to become obsolete?
Actually, the moving expenses is not completely gone. Members of the armed forces on active duty who have a permanent change of station can still deduct their moving expenses.
Okay, so they'll still have that.
So the 3903 will remain in the software, in everybody's software, and IRS will process it, but only for the people who are active duty military.
Okay.
In addition, there are some states that are probably still going to allow that deduction.
Okay.
We've heard California, I think, is going to still allow it for your average Joe, not just for military.
All right. Well, Bob, for listeners who may not have heard us discuss this before on the program, has the penalty for not being covered by health insurance been repealed?
It has, but not until the 2019 tax year. Okay. I think people got a little excited about it at first glance that it was going away, but for the 2018 tax year, you'll still need to answer that question. There'll still be that checkbox on your 1040, and as a tax preparer, you'll need to interview your clients and ask them about it still.
And with respect to it being repealed or not repealed, as what I've heard is that it's still exists, but it's zero. The
Yes.
value is zero.
Yes.
And so that probably explains why you would still need to interview your clients about it too, just to make sure you can tick the box.
Yes, that's correct. Actually, everyone is still required to have health insurance, even though the penalty will be zero next year.
Yeah.
And I believe the checkbox will remain on the 1040 that says everybody was covered,
Yeah.
even though there's no penalty.
Is there any possibility that in the future they could retroactively ratchet that penalty back up? Is that even a possibility? Because I heard someone mention that on one of our previous podcasts as kind of a flippant offhand comment, but is that even a reality?
I don't believe so. Not for 2018, anyway.
Right. But in the future, say we go 3 years down the road and we have the zero calculation for the penalty, and then for whatever reason, the future Congress decides, well, we actually need to impose the penalty to encourage more people to engage in the ACA markets or whatever. Is there any fear of people not having recorded? If I'm a tax professional, I need to make sure I record that every year that when they say no, because in case something else happened in the future where they said, well, you actually needed to have been watching that because now the penalty might have been ratcheted up to 1% or whatever.
I don't think it'd be made retroactive. If in 2020 they decide to reinstate it,
Okay.
I don't believe they'll go back to 2019 and try to collect it.
I can imagine that the political fallout from that would be pretty catastrophic. All right. Robin, will the itemized deduction schedule, the Schedule A, just changing gears a little bit, will that be changing much? We've heard a lot about SALT and job expenses, but what's going to happen with the Schedule A?
The Schedule A will look a lot the same, and there are some changes to it. Just starting at the top with medical expenses, there's really no change in that from last year. The AGI limitation, it remains at 7.5% for 2018. Moving on to the SALT. SALT stands for state and local income taxes. And there is a limitation on that, and that's been in the media a lot.
Yes.
A lot of, there's some lawsuits pending and things like that, but basically the way the calculation works is it involves the amounts that in prior years were listed on lines 5, 6, and 7. The income taxes, the real estate taxes, and your personal property taxes.
Okay.
So basically you combine those three numbers,
Okay.
still list the full amounts, you combine those numbers, and then the next line will have the limitation. The limitation is $5,000 if you're married filing separately, and it is $10,000 for everybody else. So those three amounts get cut off at $10,000. After that, then you add in the amounts that last year would have been on line 8, which would be your foreign taxes, your amounts paid to state unemployment funds, things like that.
Bob, what about, say, interests and gifts to charity?
Well, the cap on deductible mortgage interest will change going forward from the $1 million plus $100,000 of home equity interest, or home equity borrowing, I should say. It's being changed to $750,000. Also, another kind of a big change for some people is that home equity loans that aren't used to purchase or improve the house, the interest on those are no longer deductible. It used to be you could take out a home equity loan and use the money to send your kid to college or buy a new car, and the interest was deductible on Schedule A as mortgage interest. That no longer applies. You'll only be able to deduct mortgage interest that was actually used to buy or better the house.
And what about gifts to charity? What are some changes there?
Well, the only real change is that it used to be limited to 50% of your AGI was the largest amount that you could deduct as a charitable contribution. That's being changed to 60%. I don't know how many people that affects, but the more generous among us, perhaps.
And what about casualty and theft losses, Robin? What can tax professionals expect to see change on that?
There's a pretty big change in the law around casualty and theft losses. Previously, you could deduct a loss from any casualty or theft, except for the limitations of AGI and things like that. But starting in 2018, you cannot deduct a loss from a casualty or theft unless occurs in a federally declared disaster area. If that occurs, you would have registered with FEMA and have a FEMA number, account number or something, and that has to be listed on the form this year. There's a new line for that. There's a little twist in there because if you could have multiple casualties and you might incur a gain from one of them and a loss from the other. In that situation, you can still list a loss even though if it's not in a federally declared disaster area to offset your gain from your other loss. So it's kind of complicated. The 4684 does not look very different this year, and that's why, because you may need to list losses that are not in a federally declared disaster area. This is another thing that some states are retaining, and that California, for one, is still going to allow losses, and I expect that's probably because of their situation they have going on right now with the wildfires. Not every community gets that federally declared disaster area notation, but they still want them to be able to deduct the loss on their state return.
Yeah. And Bob, can you talk about changes with respect to job expenses?
That's another big change for some people, particularly people who are outside salesmen, for example. Anyone who has unreimbursed employee expenses, say for travel or whatnot, previously they were deductible on Schedule A, at least to the amount that they exceeded 2% of your AGI. That deduction is no longer going to be allowed, except for certain individuals, armed forces personnel, certain government, fee-based government officials, people in the entertainment industry. If you look at the old 2106 form, these are the people that would take their deduction on the front of the 1040 rather than on the Schedule A. They'll still be able to file a 2106 and take those deductions, but everyone else is kind of out of luck.
And Robin, let's close out the discussion of the Schedule A with other miscellaneous deductions, and then the very bottom of the form, I think we have the piece limitation.
Okay, sure. The other miscellaneous itemized deductions that are not subject to 2%, there's no change in that. There's still a specific list of deductions that you can take. At the very bottom of Schedule C, in the past has been a question, does your AGI exceed a certain number? And if it does, then you would have to complete a certain worksheet. That's called the P's limitation. That has been removed completely. So there's no longer a limitation on itemized deductions. That final limitation on itemized deductions. And that will actually affect the 6251, the alternative minimum tax calculation, substantially, because a lot of that was added back over there.
So moving away from the Schedule A, Robin, I'm going to introduce this next question with a little anecdote. I remember on the radio hearing that if you're going to get a divorce, you need to do it before January 1. So can we talk about alimony changes? Because obviously there's something going on.
I'm sure there's a lot of confusion around alimony as well. You're not alone, Ryan. So for divorces that were finalized prior to January 1 of 2019, there is no change in the way the alimony is handled. The recipient reports it as income, the payer reports it as an adjustment to income. But starting with divorces that are finalized January 1st of 2019 and afterward, that will no longer occur. The person who pays the alimony can no longer deduct it, and the person who receives it no longer has to report it as income. That's going to be a pretty major change.
Yeah.
And there's no getting around that. There is a stipulation that if you have one of the old divorce agreements, but you both agree or can get your lawyers to agree that you want to follow the new rules, you can go back and amend that divorce agreement and say that nobody has to report it on their tax return. But there's no changes allotted for going forward.
In case my wife's listening.
She better hurry.
I love you, honey. Bob, can we talk about some changes that have been made to depreciation with respect to the Tax Cuts and Jobs Act?
They have gotten a lot more liberal, I guess, than they were in previous years. You have the Section 179 expense limit has been increased to $1 million, and the phase-out where it begins to be reduced, that doesn't kick in until you have $2.5 million in new equipment placed in service. This opens up a lot of opportunities for increased expensing. And on top of that, you have the 100% bonus depreciation going forward. Although you can elect out of it, and in some cases it make good business sense to do so, for most people, you're looking at very generous expensing, very favorable to placing new assets in service.
Mm-hmm.
Very favorable for the current tax year. But if you write it all off this year, then your taxpayers aren't going to be happy in future years necessarily, because they don't have any deductions. They don't have any depreciation to take.
Let's move on to the next question. Again, Bob, I'm going to direct this to you. Are there any changes related to taxes being paid by children, the so-called the kiddie tax?
Well, that was one of the changes made by the Tax Cuts and Jobs Act. The under 24-year-old who would file the 8615 form, normally in prior years they'd have been taxed on their income at their parents' tax rates, regular tax rates. What they've done is they've altered that so that now they'd be paying tax based on the estate and trust rates. And if you look at the tax tables, at the tax rate schedules for the estates and trusts, it's a much steeper curve. You get into the maximum, highest rate, somewhere around $13,000 of income. So you're going to end up paying probably at a much higher rate than you would have under the old system.
Interesting change. So is there ever going to be a situation wherein the child who's working would pay less tax than they would have under the current or under the previous scheme?
On investment income, no.
I think it's going to be important for tax preparers to pay attention and get educated on their particular state law changes, because every single state is going to be affected by the Tax Cuts and Jobs Act one way or another. If they conform, then they're going to have to change their forms to conform. If they don't conform to what the IRS does, then there's going to be some magic calculations and worksheets and things that are going to have to be added by the state. Many years, states don't change their tax returns or their tax forms or their laws at all. But this year, they will all be changing.
All right, we'll have to leave it there for today. Now, on the next podcast, we'll be joined by Bob and Elena Romanchuk. She was with us a few podcasts ago talking about some changes related to the Tax Cuts and Jobs Act. But that's it for today. Thank you both for being here, Robin and Bob.
Thank you.
Thanks for having us.
And we'll see you all in the next Taxing Subjects podcast.